Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. And today we are looking at LanzaTech Global Inc. And let me tell you, this filing is like a financial puzzle with some interesting twists that might surprise you. So strap in as we break down what is really going on behind the scenes at LanzaTech. Alright, let's dive into what LanzaTech has been up to. On the 21st of January 2026, they entered into what they call subscription agreements with some investors, both old and new. Think of these as deals where investors agree to buy a certain number of company shares. In this case, a total of 4 million shares of their common stock were purchased. Each share went for $5, making it a $20 million deal. But here is a little something extra they threw in for good measure. For those who paid on time, they also got bonus shares. That is, right over 500,000 additional shares were given out as a thank you for prompt payment. This whole package of shares is being called PIPE shares. Now, these shares are interesting. They are for the company's common stock. Normally, this is the basic ownership stake in a company, but a really small detail here is their par value, which is practically zero. This usually means they are trying to make a lot of shares available without a huge nominal value attached to each one. LanzaTech also made some adjustments to warrants. Now, warrants are basically options to buy company stock at a certain price in the future. In this situation, they changed the expiration date for these warrants. Originally, they were set to be automatically exercised at a certain point, but now they can be exercised anytime before the 31st of December 2026 and will be automatically exercised on a cashless basis right before that deadline. This gives the company and the warrant holders a bit more flexibility. Now let's talk about preferred stock. LanzaTech had previously issued something called Series, a convertible senior preferred stock. This is a special type of stock that can be converted into common stock. On May 7, 2025, they sold about 20 million shares of this preferred stock for a hefty $40 million. At the time, these shares could be converted into 200,000 shares of common stock. However, on the 21st of January date earlier, they filed a new document that changed things significantly for this preferred stock. This new filing made sure that all of the preferred stock would automatically convert into over 3.2 million shares of common stock. This conversion happens under specific conditions, one of which was tied to the company raising at least $20 million in cash from issuing common stock, which is exactly what they just did with those subscription agreements. This means the preferred stock is now converted into common stock. There was also a waiver agreement signed. This basically means the preferred stockholder agreed to change the timeline for when LanzaTech had to file certain documents related to registering shares for sale. Instead of needing to file a registration statement very quickly, they now have up to 60 days after the warrants were issued. This gives LanzaTech a little more breathing room on its regulatory filings. All these share issuances, the PIPE shares and the converted shares, were done without registering them with the Securities and Exchange Commission. They are relying on an exemption from registration, which basically means they are selling these shares to specific investors under certain conditions that don't require public registration. This is common for private placements or when converting existing securities. Finally, on the financial front, this filing includes something called an interactive data file. This is essentially a way to present the financial information in a digital format that is easier for computers to read and analyze. It helps make sure the numbers are accurate and accessible for analysts and investors who want to dig deeper. Companies are increasingly using this to provide more transparency in their financial reporting. Now, looking at these transactions as a whole, what does this really mean for LanzaTech? The company successfully raised $20 million in new capital through these private placements, which is a positive sign for their financial health and ability to fund future operations or growth initiatives. The conversion of preferred stock into common stock simplifies the company's capital structure, reducing the amount of preferred obligations. The adjustment to the warrant terms, while seemingly minor, provides more predictable conditions for its exercise and potential dilution. The reliance on unregistered sales exemptions suggests a private offering strategy, which is typical for companies needing capital but not yet ready or needing to do a large public offering. The key takeaway here is that LanzaTech is actively managing its capital structure by bringing in new funds and converting existing complex securities into simpler common stock. This can be a sign of a company moving towards a more stable and potentially more attractive financial footing. However, the reliance on private placements for funding also means that a significant portion of ownership change is happening away from the public eye. Alright, that is our breakdown of LanzaTech's latest filing. What is your take on these financial moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.